Hello. In this video, we'll be talking about debt investments, specifically trading securities. In previous videos, we've discussed all about debt investments and the basic accounting for them for the purchase and for the recording of interest received and interest accrued, interest revenue. In this video, and we talked about that there's three different types of debt investments. There's the held to maturity, which is in the previous video. In this video, we will be talking about trading securities. Trading securities are either bonds, notes, or even stocks that are purchased and sold very quickly. They're held for a very short time and they're resold very quickly. They are usually not held for more than 3 months. Typically, when a company purchases a bond or a note or stock that's considered a trading security, they will buy and sell them within the same day sometimes. A trading security is carried on the balance sheet at the fair value, and any unrealized gains and losses are recognized, which means they are recorded in net income, and therefore they're part of retained earnings and therefore shareholders' equity. So like I said, trading securities are investments whether in debt or equity, so equity would be stock, that are acquired really for purposes of selling them in the short term, in the near term. And companies usually are very active in buying and selling these securities, and the holding period can be very, very short. So therefore, typically they're reported in the investor's current assets as an investment. We carry these securities at their fair value because it is more relevant. Because they're being sold at a very short in the near future, then the fair value is more likely of what the company will actually get for them. And so therefore we carry that's what they're shown at on the balance sheet. So even if we true up their value period over period, if in case they're not sold that period, the gains and losses are not yet realized, meaning they're unrealized. They're still included in the net income in the income statement. So the question is, how do we record these investments to their fair value? And we're going to go back with the same example we've been using in the previous videos, where Masterware sold bonds to United. And for the bonds had a face value or principal value of $700,000, but they were sold on 7/1/27 at a discount of $666,000 something. I can't remember the rest of it. But on 12/31/27, 6 months after they were purchased, their amortized cost went up to $671,297. If you're not familiar with how this number is calculated or where it came from, please go watch the video called Effective Interest Method. So no matter if you have a held to maturity, a trading security, or available for sale security, you're still going to record the purchase of the investment all the same way, and you're still going to record the premium or discount and amortize the premium or discount over the life of the bond, depending on the number of periods that interest is paid. Again, if you don't know what this means, please go watch the Effective Interest Method video. So let's go back to this example. Masterware bonds have a fair value on 12/31/27 of $714,943. The amortized cost on at 12/31 is $671,293, which means that we need to increase the balance of this investment by $43,646, because currently this is the balance on the balance sheet. So how do we do that? We're going to introduce a new account, and it is an asset account, and it goes along with the investment account, and it's called fair value adjustment. So this is an asset, it goes with the investment account, and we're going to debit fair value adjustment for the 43,000, and the credit is going to be gain on investments. Even though we have not yet sold this investment, we are going to recognize this gain on the income statement. So NI stands for net income. I want to make that point really clear, because when we do the available for sale investments, we also will record a gain on investments, and it'll be unrealized gain, but it will not affect net income. It'll affect their OCI. So we'll get to that in another video. There's this asterisk here, and it's important to note this asterisk that this fair value adjustments, some companies have a separate account called fair value adjustment, and it's an asset, and it goes with an investment account. And when I say that, it means it's combined with the investment account. Some companies don't even bother with this account, and they just book the increase or decrease to the fair value directly to the investment account. In these examples, we are using the fair value adjustment account, but just want to highlight that point. Okay, back to that same example of, let's assume that United, that's the investor, right? That's the company that purchased these bonds, sells the bonds for $725,000 on January 5th, 2008. Well, so now we'll say that the amortized cost on the balance sheet is this number, $671,297. If we're selling these bonds for $725,000, then that is the fair value on that date, on January 5th. That means that our fair value adjustment balance needs to be a total of $53,703. Note, this is not necessarily the adjustment, the current year adjustment. This is the balance, which is a very important thing to note. Here's the reason. When we look at 12/31/27, we already adjusted this account, this fair value adjustment account. We already recorded a debit of $43,646. That's right here and right here. So we trued up the value of this bond, of this investment, at 12/31/27 by 43,000. So, and now 5 days later, on January 5th, 2028, the balance should be 53,000. So my beginning balance is 43. My ending balance on the date of sale needs to be 53. So what's my adjustment? It's going to be 10,000 something, right? 10,057. So you're going to debit fair value for 10,057 and another gain on investment for 10,057 that goes on the income statement. Now we need to actually record the sale of the transaction itself. So note, this was step one, was adjusting the trading security to fair value at the date of sale. So we've just simply, what we've done is we've just adjusted the investment account to be 725,000, right? Because we increased the fair value such that the fair value, the investment plus fair value accounts equal 725,000. Now we need to record the actual sale and get this investment off of our books. And the way we do that is we're gonna, well, we got cash for 725,000. We're told that. We know that we have investment in this bond that we recorded on 7/1/27, the initial purchase of this bond. We debited investment in bonds, so now we need to credit investment in bonds. We also have a credit balance in the discounted bond investment account. If you don't know where this came from, please go back to the effective interest method video, and we're going to debit that amount for the discount amount that's left to amortize. And there we go, we're going to credit the fair value adjustment for 53,703. So in the previous slide, when you look at the T account right here, right, you look at this T account on the date of sale. So this is on 1/5/28. Our fair value adjustment balance sheet account is 53,703 on the debit side. So now we need to get rid of that. So we're going to credit the fair value adjustment for 53,703. Notice there's no gain or loss recorded here. It would have been a gain, but there's no gain recorded in this sale. And that's because we recognized the gain over a period of time. We recognized a portion of the gain at 12/31/27. We recognized $43,000 of that gain. And then on January 5th, when we adjusted the security to fair value, that was the first entry we did, we recognized another $10,000 of the gain. So when we're actually recording the sale on the actual transaction, there's no gain account to be recorded. There's a FASB that says in order to expedite some of the accounting for this, sometimes a company may not necessarily record the adjustment to fair value on the date of sale like we did here. They might not necessarily record this entry on January 5th, right? They might just combine this adjustment with the second one and just record the sale on the date of sale on the January 5th and record the additional $10,000 gain with it. So they would actually just say debit cash 725. They would credit the investment account for 43, and they would debit the discount on bond amortization for 28. So far, this is all, these three adjustments are exactly the same as before. What's different here is that we don't true up the fair value adjustment for that 5-day period. We just keep it at the 12/31 balance, the 12/31/27 balance, which was 43,646, and we're going to credit that amount, which means we would credit that amount, that gain for 10,000 along with this entry. So net you get to the exact same answer. It's just some companies don't do it in 2 steps, some companies do it in 1 step, and that's okay. Okay, talk about the financial statement presentation for the trading securities. No OCI component for trading securities. The gains and losses are included in the income statement in the periods for which fair value changes, regardless if they're realized or unrealized. So whether or not the investment has been sold or not, you're going to adjust the investment account to by using the fair value adjustment account to its fair value, and the other side of the entry will be either a gain or a loss in the income statement. So at the same time, you're going to record a fair value adjustment account on the balance sheet, depending if the value is going up or down. And on the statement of cash flow, when you buy or sell securities, they're classified as an operating activity. Let's look at the actual financials for 2027 and 2028, right? We sold it on January 5th, 2028, and we've trued up our accounts to 12/31/27 at the end of 2027. So when we look at for 2027, what we have on our income statement for this was the first period from July 1 through 12/31/27, we have interest that we've earned for 46,664, and we discussed that also in the effective interest rate method video. And now we also recorded a gain for 43,646. That was to adjust it to the fair value. So on our income statement, we have income of 90,000. Note, both of these items go under the other income and expense item. They don't go in their operating expenses, but that $90,000 income will flow right into the retained earnings amount. On the balance sheet, we have our investment in bonds. See how the investment account plus the fair value. So this is the investment account. I don't know why that X keeps coming up. It's really kind of annoying, so I apologize. That investment plus the fair value accounts are combined right here together on the balance sheet. And on the statement of cash flows, you have your cash received, cash from interest received for $42,000. That's the cash we actually received. And on 2027 is when we actually purchased this investment, and we had to give cash of $666,000. Then on 2028, when we sell this account, this investment, we record that other piece of the gain, the $10,057. So in total, between 2027 and 2028, our total gain is that $53,000 that we've seen in the previous slides. That gain goes on our income statement, which gets added to our retained earnings. So the $10,000 from 2028 plus our prior retained earnings of $90,000 gives us retained earnings for $100,000. And we have no interest that we've received in 2028 because we sold this so early in the year, before June 30th, which would have been the next interest payment. But we sold the trading security for $725,000. And again, these items all go under the operating activities. This is different than the held to maturity, because the held to maturity one everything would be reported in the investing activities on the statement of cash flows. So that's one difference between the statement of cash flows for held to maturity versus trading securities.